It's Brian Preston, the money guy.
All right, Brian. So we talked about the 20s. The 20s is this decade where we are building the base. We're doing our foundational knowledge. Well, then we get into our 30s, and we, no matter how many times we try to change the name of this, we don't change it.
30s, I don't know why you try to change the name of this.
I like coming up with creative things, but it's just so true. It is, in fact, and I'm living this so very truly, 30s is the messy middle. It's when things change. This is like
you throw the arrow, you throw the dart, and it hits the bullseye, and now you're upset that it's on the left side of the bullseye versus, I mean, when we call it the messy middle, I think that this is actually comforting because I think it is hopefully every one of you who are in your 30s and you're like, man, I made it through my 20s. I'm in my 30s. I thought this would be feeling easier right now, but it's just not because you're super busy at work. You know, if you got a significant other, you're trying to figure out the whole family thing and then add on there this whole craziness with the real estate market and that first home purchase. It is perfectly okay that this is called the messy middle because I think that should hopefully give you some comfort that you're in the right season of life.
All right, so let's talk about the financial planning pyramids or the basics. In your 30s, now it's likely that your cash flow has changed. You're likely making more money, whether it be through wages, income, side hustles, bonuses, than you did in your 20s. So one of the things you want to make sure you do is that your savings rate follows suit. I see this all the time with my friends, Brian. I'm like, hey, start saving in your 20s, $500 a month, and max out that Roth IRA. And they start doing it. Well, they get some promotions and their job circumstances change. In their 30s, I'm like, hey, man, how you doing? Like, oh, Roth is doing great, still doing $500 a month. And I'm like, no, dude, you got to like, as your income goes up, so too does the amount that you are saving. That's why we talk about that 25% savings rate that you ought to be shooting for. If your income increases, so too should the dollars that are going into your army of dollar bills.
Yeah, I mean, it's a big part. I have a lot of grace for my 20-somethings because I know you come from, pretty much zero and you're building this thing up. So to say 25% of your gross income is hard in your 20s, in your 30s, you got to be reaching completion on reaching that goal. And a big part of this, lifestyle creep. Yep. And this is the thing. Look, you make a mistake we hear about the latte factor and all these things where people are buying coffee. That's not really what we're seeing the problems. The problems we see for 30-somethings is how big is that car and that car payment? How big is your mortgage and that mortgage payment? Because instead of $100 a month mistakes here, we see thousands of dollars a month of mistakes that just are being spent on the cost of just staying alive and looking good versus building that great, big, beautiful tomorrow in the future.
Yeah, there's some really interesting statistics that Daniel pulled for this on us. We know that right now, the average age of a first-time home buyer is 34 years old. That's kind of remarkable because in our experience, both of us bought our first home before age 34. What I think is really even more remarkable, I think it's probably one of the reasons that this age has increased over time, is that the median home price in this country right now is $408,000. That is an increase of over 24% since pre-pandemic, since the beginning of 2020.
That's disgusting.
It is remarkable how much more expensive houses have become. And because of that, it's pushing that large decision that a lot of us will make in our lives out into the decade of the 30s, right there in the square, in the middle of the messy middle.
Yeah, I'm biting my tongue because this is one of those things between the student loan crisis as well as now the home prices for first-time home buyers. We've got a problem. That's why, I'll bite my tongue because we're not a political show, but we need more younger people in government or involved with it. I think the time for the 80-year-olds that are running all policies, we ought to really rethink it because I don't think that's a political, because it's both sides. But it is definitely, we have an issue here that we need to make sure. But hang out there. We're going to get through this, and I still am very optimistic in the long term that there will be opportunities that come.
And so I think a lot of people out there are saying, hey, well, I can't control this housing thing. This is something that's happening against my will. I can't fight it. That very well may be true right now. However, there's another consumption decision that we see a lot of people making, and this one very much is inside of most of our controls, and that's how we purchase automobiles. Right now that we know when it comes to buying a car, the average auto loan term for a car is 72 months. I know most people don't even keep their cars for that long, but they're having loans for 72 months. And 1 in 3 folks right now who trade in their vehicle, they're actually underwater on their loan. So they are trading in negative equity. You will never build wealth that way. You will never reach financial independence if you just keep rolling it in. So I think in your 30s, when you actually have the money to be able to qualify for these loans and you can get into luxury cars, you have to really check yourself and say, man, am I doing the things I'm supposed to be doing? And am I doing them in the right order? Or am I getting things out of whack?
I mean, remember, I said moneyguy.com/resources. We have the free deliverable of the 9 steps of the financial order of operations. Guys, the fancy cars, that stuff doesn't happen until you're on steps 8 and 9. Yep. I mean, there is nothing wrong if you realize 23-8 is what we talk about all the time, meaning that you're putting down at least 20%, and realize this formula is grace-filled so that you have a reliable car that will get you to work, because working and building wealth by automated investing is what's going to happen. So 20% down, 3 years, no more than 3 years on the financing, and no more than 8% of your gross income. And we're talking about non-luxury brands. If you want to get into luxury type stuff, it's got to be same as cash. I want you essentially paying it off in the next few months after you buy it. And also, do not fall in the trap that your car payment is higher than what your monthly investment is, because you are way backwards if you're doing what Bo said. You're doing $500 a month to load up that Roth IRA, and then you have a $750 car payment. No. That's not the order we want things. We want a $250 to $400 car payment, and we want $1,200 a month going in that investment. Let's get this thing, let's blow it out so that you do get that great, big, beautiful tomorrow.
Because remember, even in your 30s, your dollars are so powerful, so don't miss out on that. Don't squander that. Here's another thing, Brian, that I think we see all the time. In your 30s, you should probably start answering this question, and you should know the answer to this question. Is what I'm doing right now a job, or am I actually in my career? Is the thing that I'm doing now something that's building for when I get into my late 30s, 40s, 50s, or is this just a clock in, clock out, and I'll find something next year? The answer to that question matters and can have a big impact on your overall financial life.
Yeah, there's some data to this. We love throwing some data, and I questioned Daniel on this because he found 19% of Americans are unhappy with their job, and I was like, well, wait a minute, I need more information than just telling me 19%, because when I see that data, I'm like 81% are happy. That seems really high, and it is sad. This pandemic, I'm curious to see what happens post-pandemic with this research, because a lot of our data closed out in 2019, pre-pandemic, but we were on a positive trajectory with career satisfaction, because in America, we had gone from 41% to 55% of Americans were saying they were satisfied with their job and somewhat on the happy spectrum. That's a positive thing. I'm curious to see what happened through the pandemic, but I'm an optimist that hopefully things get back to a positive trajectory on that.
Would you agree with this statement, Brian? The 30s might be the last stop where making a transition, making a shift is easy, right? Like as you get into your 40s and as life changes and you have kids and you have older kids, you have more commitments. If you're stuck in a job that you just can't stand and you're biting your fingernails on Sunday, it gets a lot harder to do that the longer you wait. So in your 30s, it really might be valuable to do a self-assessment saying, am I doing what I want to be doing long-term? Now, that doesn't mean that you love every absolute thing about your job and you're skipping to work every day, but it is a realistic assessment of, okay, this is something I want to commit to for the next 10, 15, 20 years.
Well, definitely focus on this in your 30s, because just naturally the system starts, even though I know it's illegal. I mean, being the child of a father that was displaced in his mid 40s, it's tough. It is really tough when the system closes out on you and says, hey, we're going to, downsize, or we're getting out of this industry. You go find something else to do. You need to get yourself in that career in your 30s so that you don't get that wake-up call in your 40s that could really put you in some shaky financial ground. And like I said, I think it turned me into who I am, but it was definitely a struggle growing up in a household where essentially the carpet was ripped out from underneath us.
All right, let's talk about risk management in our 30s. Likely at this age and stage, you're starting to have other human beings that depend on you. Perhaps that's a spouse, perhaps that's kids, perhaps that's aging parents. You start to feel some pressure that, man, if something happens to me, there are other folks that will be affected by this. If I get hit by that bus and it takes me out, that's going to be a problem for my family. If I get disabled and I can't go to work anymore, that's going to be a problem. So you need to make sure that if there are folks depending on you, if your livelihood affects the livelihood of others, you need to make sure that you insure against those types of risks. The two easiest ways to do that are life insurance. We love low-cost term life insurance, and disability insurance, which we often see underinsured, which is actually a much higher probability thing of happening than premature death.
Remember, we said term life insurance. So if you got like kids that, are here, you're looking at typically the term when you think you can self-insure afterwards. So that might be 20 years for the kids, or 25 years, even 30 years. But we're talking about term life insurance, not the permanent expensive whole life. That's a different purpose on that type of stuff. This is exactly what Bo said. We want to make sure that if you're in debt or you have to still haven't fully funded all your retirement savings so that your spouse or significant other would be in a tough situation, or the kids are going to be in a tough situation, it's too cheap, too affordable to afford to just insure that. Just make sure you do that step, because you might be shocked. It's a few $100 a year to really make this risk go away.
All right, and so we talked about in your 20s that you should be building towards step 4 of the financial order of operation. You should be building your emergency fund. In your 30s, that becomes a non-negotiable. You need to have, depending on what the right number for you is, 3 months or 6 months, your fully funded emergency fund. Again, because people are now depending on you. If something goes wrong, it affects other people. So it becomes a non-negotiable at this stage of your financial life.
Yeah, when we do the financial order of operations, remember moneyguy.com/resources. You too can download it. Step 1, deductibles covered. That's just so you don't let just something out of the blue side rail your entire financial life. When you get to step 4, the financial order of operations, which is the true emergency reserves, guys, we're counting on in your 30s that you kind of are trying to build yourself that stable foundation for your family. This is the point to make sure, exactly what Bo said, 3 to 6 months, depending upon how many working people are in the household, also how easy it is for you to get a new job. Pay attention to those factors.
And then here's the last one. This is just often overlooked. Umbrella insurance.
Yeah.
It is a very low-cost insurance that sits over the rest of your financial life that will protect you. If you have assets, or if you have income, or if you have income potential, umbrella insurance is something that makes so much sense in so many circumstances. And yet time after time, we see folks who don't have it. If you're curious, just call your property and casualty insurance agent. Tell them you want about your net worth of umbrella insurance, rounded to the nearest million most often. So 1 million, 2 million, 3 million, whatever the number is, and see how much it is. You'll be amazed. It is very low cost, affordable insurance that you should likely have in place.
Let's talk about investing. Okay. This is the stuff that rubber meets the road on actually building the wealth. We want you at 25% of your gross income. We also, you're asking yourself, probably in your 30s, since you are having kids, you're like, when do we actually start saving for college for the kiddos? I think this is a step 8 moment, meaning that this is going to come after hyperaccumulation. Right. So after you've reached 25% of your gross income, going to that great big beautiful tomorrow, that's when you can start thinking about the kids.
And then another thing that likely happens in your 30s, depending on kind of where you are in your financial life cycle, is you might actually graduate past target retirement index funds. You know that we say all the time, for those in your 20s or those starting out, we love the automated nature of target retirement index funds. But when your portfolio does hit that critical mass, $400,000, $500,000, $600,000, it's likely that you could benefit from a more specialized asset allocation, how you spread out your assets, and an asset location, where you put your assets. So in your 30s, if you do start to approach those critical masses, it's a time to start having those conversations and thinking through, okay, do I need to move from general investment advice to very specialized for my circumstance investment advice?
And don't forget the savings rate. I mean, I've said it 25%, but savings rate and using index target retirement funds while you're building up to that critical mass that Bo just talked about is still going to be the most important behavior and factor that will lead to an indicator of how successful you'll be.
All right, Brian, so let's talk about tax planning. Oftentimes when we start out, we're young, we hear Roth, 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 Roth. And that's true because tax-free growth is awesome. However, there are times when pre-tax makes sense. It makes sense to go to the traditional side of your 401k if you're in a higher income level. In your 30s, this often happens. Don't forget to assess this. Every year, maybe at open enrollment or whenever, think through, should I still be doing those Roth contributions or might I benefit from going to pre-tax contributions for the current year tax savings?
I also think this is a point where, because look, you're messy middle, you are having some career success, you got the kids in the house, you're trying, you're reaching probably that critical mass point over $500,000, $600,000 of investable assets. Nothing wrong with trying to bring in outside help with, a financial advisor, somebody to help you protect yourself from those blind spots or maximize your potential. Don't be scared to do that. I think that's a great planning opportunity.
All right. Now, on the estate planning front, if you have children, you need a will. I'm going to say that again because it's that important. If you have children, you need a will. One of the things we always ask prospects is, hey, if something were to happen to you guys, who would take care of the kids? And normally the spouses kind of do this number. If you're listening on iTunes, you can't see me, but they kind of look at each other and they're like, well, my brother, no, your sister, no. Well, if it's difficult for you to make the decision about what happens to your kids while you're here, imagine how much more difficult that will be if you are not here. That's why the estate documents make so much sense. You just have to have them in place. Don't put it on the back burner. Get it done so that you can speak for yourself if you're not here to speak for yourself.
And before you meet with that attorney, go ahead, because I do think this is graduating beyond the boilerplate and graduating beyond even the back of the napkin, as you call it, Bo. You need to know, who do you want to be the executor of your estate? Go ahead and have these conversations, the guardianship for your children, and then any trustees that you're going to have from those testamentary trusts that will be built into your estate document. Go ahead and have those conversations. Go ahead and know who you want to talk about with the attorney so that you can go ahead and do your homework, because every bit of research is going to save you money in preparation of those expenses.
And then as family circumstances change, don't forget to update beneficiaries. Again, if you have a new child born, you want to update that. If someone in your life passes away, you want to update that. Make sure at least every couple of years you're checking the beneficiaries across all of your accounts, not just your IRAs, housing your custodian, but also your 401ks, your life insurance, so on and so forth, to make sure that what you want to happen is indeed what's set up to happen when you pass away.